It's 5 a.m. in New York City. Good morning. I'm Lizzie Burden with your Bloomberg Brief, standing in for Danny Berger. Here's what you need to know. No more extensions. President Trump vows there'll be no more delays in his tariff agenda come August 1st. Turmoil in metals. The president announces a 50% levy on copper imports, causing a record spike in the commodity. And letter to Brussels. The European Union's new tariff rate could be declared in the next 2 days as it tries to cut a deal. Well, he ain't backing down. The president has slapped this 50% tariff on copper imports, far exceeding expectations, and saying there are going to be no extensions for country-specific levies, and saying that there are more announcements in the mail. But this market is tired of the trade uncertainty. Today was meant to be the day when we got clarity, and starved of it, futures are struggling to find direction this morning. Look at your bond space as well. It's the fifth straight day of selling pressure for treasuries. 439 is where we are at on the 10-year, but we've got to look at copper here because we had that record spike in New York futures yesterday, a drop in the global benchmark, and this is a watershed moment for the red metal, according to Citi. 5.53 cents a pound is where we're trading right now, stateside at least. But let's look at your pre-market movers. Joe Easton's here with that. Joe, what are we watching?
Hey Lizzie, so we're watching autonomous driving software in the pre-market, but it's not Tesla today, it's Mobileye. We've got news of a share sale by Intel, potentially around $800 million worth of the stock, and therefore we're seeing some pressure in the pre-market on Mobileye. We're down around 3% at the moment. The other angle to this is whether it's Intel needing cash to try and compete with the other rivals like TSMC, so keep an eye on Intel as well. Then over in pharma, a couple of stocks to bring you. Verona, the ADRs of this one jumping following a Financial Times report that Merck is coming in for the company and offering a decent premium as well. That could be a $10 billion deal, and we're seeing Verona, a maker of drugs to treat lung diseases, rising close to 20% in the pre-market today. And then finally, one more to bring you. It's a bit more in the smaller cap space, but there is a profit warning out today from a company which is not Rackspace Technology. I may have got the ticker wrong on that one, but we have got a little bit of a warning in the mid-cap eye lenses space. There will be a decliner. Catch that one in my later segment. But as usual, check out the Before the Bell opening wrap, which will include the correct information on that mover, Lizzie.
I'm going to hold you to that, Joe. We'll see you in 30 minutes' time. Thank you. Now, in just moments, we're going to hear from Iain Stealy of JPMorgan on his read on the bond market. And later in the programme, we'll be speaking to Kallum Pickering of Peel Hunt. He'll join me to talk tariffs, trade and the Fed. But this uncertainty in tariffs is persisting, unfortunately, with the president sticking with August the 1st. And joining us now is Iain Stealy, International CIO for Fixed Income over at JPMorgan Asset Management. Iain, always a pleasure to see you in the morning. Thanks for joining us. If you look at volatility, right, it looks like you haven't actually got back to anywhere near April 2nd levels. It kind of suggests that there is optimism, there's going to be room for negotiation in these trade talks. You can see it in the gold price too, down as well. Is this optimism on trade misplaced, do you think?
I don't think so. I think what the market is learning, and you said it very well, the market's got a bit of fatigue around tariff headlines and the news flow that's happening. And what the market's learning is that there is room for negotiation. We've had an extension again. We're now talking August 1st. We've got another 3 weeks for people to be negotiating with the US, and that's exactly what they want. So the president, he wants to keep up the rhetoric. He wants to continue to put pressure on the countries that he wants to do deals with. But I think the market's saying ultimately what they do want is they do want deals. They would prefer to do that than be slapping on these very high tariffs. So at the moment, we are seeing a reasonable amount of calmness. Now, again, if we get closer to August the 1st and nothing has happened, then I can see some volatility picking up. But I think we've got a couple of weeks for more conversations and more discussions to be had.
But Iain, when Trumponomics assumes that tariffs will help at least to pay for tax cuts, is it wrong to assume that much relief is actually coming on August the 1st? Is that perhaps why we've seen him stepping up on copper tariffs today?
Yeah, maybe we don't get a huge amount of relief from where we are. And actually, the reality is the sort of average level of tariffs is probably going to be a little bit higher come the end of the day. But I think what we're not going to is back to those levels that we saw early April, where we were talking in the mid-20s and those really high levels on China. I think that's what the market is taking comfort from at the moment, and that's why we're not really seeing a huge amount of volatility this week when, historically, if you'd said this was going to happen, you would have expected the volatility to be picking up, but we're just not seeing it at the moment.
And of course, like everybody else, the Fed doesn't have any clarity because of this deadline extension. Does it stop them cutting in September?
I think really September is going to be very much down to the jobs report, and we had another report, or the employment picture. We had another jobs report last week, which again I think the market had set itself up in anticipation of a weak print, and under the surface I don't think it was particularly great, but obviously it wasn't as bad as maybe was being feared. I think that's going to be the big factor that really will lead to the Fed making the decision whether it goes in September. Are we seeing weakness occurring in the employment picture? Currently, with an unemployment rate of 4.1%, it's hard to argue that they need to be very aggressive from here.
And what level of average effective tariff rate, and we're trying to guess where it lands, is going to be high enough to harm corporate credit stateside?
It's really difficult to say that because we just don't know exactly how much tariffs are going to be passed on. Corporates are in a very strong position at the moment. Margins are very elevated. When our credit analysts have done the analysis and they looked at 10% tariffs, they looked at 20% tariffs, both of them did cause a sort of a falling off in earnings, but ultimately it wasn't the recessionary numbers that you'd have seen through previous slowdown periods. So I think actually credit and corporations will be able to withstand these tariffs. I think what will be very interesting for us to look at is, as I say, what gets passed on, what has to be absorbed by the consumer, and then what are the consumer spending patterns once we know that information. And again, it's going to take us a little bit of time to see that all come through into the data.
Iain, I don't want to neglect the fiscal story here. Of course, we've got the trade headlines dominating, but we're still looking out for the bond vigilantes. There's no sign of them at the moment. Do we basically conclude that this is a president who can do whatever he likes fiscally as long as he funds it with T-bills?
I'm not sure I'd say he can do whatever he likes fiscally, but ultimately I think this is where, when I look at it, tariffs are here to stay, because ultimately the bill is going to create additional spending that's requiring funding, and they're going to use the tariff revenue to fund a lot of that. What it does mean is, though, that you'll see, I think in the US, what we've seen in the UK and what we've seen in Japan is where the Treasury will be looking at issuing more in the front end rather than the longer end and trying to keep funding costs down. I think it will be interesting, though, to see as to what the private sector says as to what level they're willing to buy those bonds at, even in the sort of the more intermediate types of the curve. Because ultimately what we've been seeing over the last couple of years or so is that the public sector, through quantitative tightening, through no really additional of currency reserves, they're not the main buyers. They're not the price setters of government bonds anymore. It is the private sector. So what are they willing to pay for it? I personally think 4.5% on a 10-year Treasury, though, is a pretty good level.
But, when you've got a president pressuring the Fed to cut rates, calling Jay Powell most recently a baby, isn't that a classic case of fiscal dominance? Yes,
it is. But I always say, though, be careful what you wish for. Because we saw back in September of last year when the Fed did do the oversized cut of 50 basis points, and then the market said, actually, maybe the US economy didn't need that. And we saw 10-year Treasury yields move 80 basis points higher over the next couple of months. Now, there were some other things going on. Obviously, there was the election and there was the movement towards the current administration. But I do think in this current environment where we do know that, or we do expect at least inflation to be picking up over the second half of this year because of tariffs, and the employment picture still looks in a pretty good spot, although maybe there are, it's trending slightly, it's slowing off. I think, let's be careful. If you cut rates aggressively at the front end, I do think that could lead to actually back-end yields, which is actually why I would still advocate curve steepeners really across the globe.
And Iain, you're in London. I've got to ask you about this long-end gilt sell-off that we saw last week. Things have pretty much recovered, but the Chancellor's fiscal woes have not. What could be the next catalyst for a gilt market puke that could spill over to the rest of the world?
I think it's still a concern around the state of the fiscal situation in the UK and how they're going to fund it. And if we do see slowing growth, then ultimately there are concerns around the growth trajectory, concerns around the growth trajectory in the UK. Now, if at the same time we start to see service inflation come down and we start to see the Bank of England being able to be more proactive on rate cuts, and I think that could well be the case as we move into the second half of this year, then actually I think the gilt market also looks pretty attractive at the moment. But I say, exactly as you said though, there was a bit of a wobble. We had a bit of a concern around that, and obviously the government stepped that back, said yes, Reeves is going to continue in her role, and I think that did give some comfort to the market. What the market doesn't like is uncertainty. So if we get a bit of stability and we do get more of a sense of the Bank of England being able to lean into this, then actually I think gilts look quite attractive at these levels.
I'm afraid there's a lot of uncertainty around, but Iain, it's always a pleasure to see you. Iain Stealy at JPMorgan Asset Management, thanks for starting your day with us. Now, on to some other top stories trending on the terminal this morning. Sources say that SpaceX is discussing plans to raise money and sell insider shares in a deal that would value the company at around $400 billion. That would mark the largest ever valuation for a privately held US company, surpassing SpaceX's previous record of $350 billion. A representative for SpaceX didn't immediately respond to a request for comment. And Sam Altman hasn't yet spoken to Mark Zuckerberg since Meta took some of OpenAI's top engineers, but he looks forward to a meeting with Zuckerberg at the Sun Valley conference this week. Altman spoke to reporters at Sun Valley about retaining talent.
I think we have obviously we have an incredibly talented team, and I think they really love what they're doing. Obviously, some people will go to different places. There's a lot of excitement, I guess we could say, in the industry, but no, I think we feel fine.
And sources say Meta bought a minority stake in the world's largest eyewear maker as it deepens its commitment to smart glasses. The stake is worth $3.5 billion, and the two companies have worked together for several years to develop AI-powered smart glasses. Representatives for both companies declined to comment. Well, coming up on the programme, President Trump sows fresh chaos in the metals markets. We'll bring you more on his latest tariff threats next.
I believe the tariff on copper, we're going to make it 50%. We'll be announcing something very soon on pharmaceuticals. We're going to give people about a year and a half to come in, and after that they're going to be tariffed. If they have to bring the pharmaceuticals into the country, the drugs and other things into the country, they're going to be tariffed at a very, very high rate, like 200%.
Our top story, President Donald Trump is sticking with his aggressive tariff regime. Trump ruling out any further extensions, and metals prices are on the move after the president threatened substantial new rates on copper as well as pharma imports. So team coverage starts now. We're joined by Bloomberg's Brendan Murray, who leads our global trade coverage, and Clara Ferreira Marques, who's managing editor for commodities and energy in Asia. Good morning to you both. Clara, let me start with you. The president has long warned that it's time for copper to come home, but I don't think anybody was expecting a 50% tariff. So what changed here?
Well, there's a lot we don't know, and that's one of the elements we don't know. We do know, however, this is a 232 investigation, so we had expected it to come a little bit later in the year, and I don't think the market was expecting 50%, perhaps half that. You can see that in the very strong reaction in the COMEX market overnight. I think that really tells you everything. The interesting thing, though, is if you look at the spread between London and New York, it probably hints that perhaps not everyone in the market is expecting a full fat 50% tariff to be fully implemented.
Well, yeah, talk us through those price dynamics there. What does it actually mean in terms of how copper is going to be moving around the world in response to these tariff threats?
Well, as far as we know, and remember, we don't actually know a lot about what kinds of copper will be tariffed, and that is actually very important. The US, for example, has very little or indeed almost no processing capacity. It's not at all clear how they will manage that. But what we've seen in the last few months is huge volumes of copper being sucked up by the US, and that's really created a big distortion between the US and the rest of the world. A little bit of that continuing, but what today marks, or what yesterday, last night marked in the US is a change, a watershed. Now the market is calling time on that and looking through and thinking about what happens when a lot of this copper that's been piling up in the US is going to come flooding back into the rest of the world. What we're looking for today and in the days and weeks to come is really how this works, what are the details, how is it applied, what's the timing, and who will get an exemption. I think that's really, really fundamental at this point, particularly for countries like Chile, the world's largest copper producer.
Well, yeah, Brendan, let me bring you in here, because it's not just copper. The president's also threatening tariffs on drugs, on semiconductors and other metals. Today was meant to be the day when we got certainty on trade, but the threats just seem to be ramping up. Do you expect more of these announcements? How do we expect it to be choreographed over the coming days and weeks as we head towards August 1st?
Yeah, this is pretty a classic Donald Trump move. The body language yesterday from the president was very much that he's frustrated that these other deals, these trade agreements, are not coming together. So what we heard him say was, I've got this other mechanism to impose tariffs on you. Now let's remember, the 232s can be used pretty broadly. So it's not just the raw material of copper. They can apply it to products containing copper as well. So I doubt Donald Trump wants to bring copper mining back to the United States, but it's the way that those 232 sectoral tariffs can be applied that will really make countries like Canada or Mexico stand up and take and be alert to the threat of this. The other issue is the pharmaceuticals. Now remember, Trump is in the middle of a negotiation with India and the European Union at the moment. Both of them would suffer a lot of economic harm if there were pharmaceutical tariffs on their exports. So there's a bit of gamesmanship going on here. And copper as well could play a role in the USMCA review that's upcoming as well. So in the broader sort of trade matrix that the Trump administration is gaming out here, this plays into more leverage that the Trump administration is trying to apply to trading partners who are currently not coming to the table and signing any of his agreements.
Well, yeah, you mentioned the European Union. It seems a lifetime ago, but yesterday, of course, euro-dollar was up on the hopes of a US-EU deal. Now Trump's saying that he's not far off sending Brussels a tariff letter despite the progress in the talks. We've heard from the European Commission President Ursula von der Leyen earlier saying that she had a good exchange with Trump, though. Let's just take a listen.
I had a good exchange with President Trump earlier this week to help move things forward. We're looking for a reliable framework from which we can keep building our common trade. So the message is clear. We stick to our principles, we defend our interests, we continue the work in good faith, and we get ready for all scenarios.
Brendan, I'm not sure the message is clear. Tell us what's going on behind the scenes.
Well, the Europeans the ambassadors will get together and try to figure out how much pain they're going to be able to take from this framework that they're trying to work out with Trump. They are also preparing retaliatory measures if it comes to that. But President Trump has made no secret about the fact that he views the European Union as the worst violator of the global trading system from the U.S.'s perspective over the past few decades. So if there is a deal, it will come together with what he sees as, the most unfair trading partner that the U.S. has, even more so than China.
And of course, every country's been lobbying to get a deal that works for them. Which sectors do we think are actually going to be the winners and losers in a potential EU-US deal?
Yeah, so the European Union seems to be, drawing a red line around Airbus and many of their automakers. So those are the key issues, also subject to 232 tariffs that the Trump administration has rolled out.
All right, Brendan Murray, Clara, Ferreira, Marques, lovely to see you both this morning. We thank you so much for your team coverage. Coming up on the programme, a look at what else is making headlines, including a possible deal for the drug maker Merck. This is Bloomberg. This is Bloomberg Brief. I'm Lizzie Burden in New York. Time now for your front page news. A look at what's making headlines around the world. First up, the Wall Street Journal reports that President Trump has decided to delay the reciprocal tariffs to August 1st after advisors, including Treasury Secretary Scott Bessent, told him he could get trade deals with more time. Sources told the Journal officials felt as if they were making progress on deals with several trading partners like India and the EU as Trump's previous deadline approached. Next up, let's look at the Washington Post. The Supreme Court clearing the way for the Trump administration to launch plans for mass firings and reorganizations at 19 federal agencies and departments while litigation continues. In response to other emergency requests from the Trump administration, the Supreme Court has sided with President Trump's efforts to upend the federal bureaucracy. And let's look at what's splashing the Financial Times. They report that Merck is closing in on an approximately $10 billion deal to acquire respiratory drug maker Verona Pharma. It'd make the US drug maker's biggest acquisition in 2 years as it expands in respiratory medicine. Sources tell the FT Merck would pay a 23% premium to Tuesday's closing price. Discussions are at an advanced stage and an agreement could be announced as soon as today, barring any snags. Let's check in on these markets, and we've got futures at the moment pointing higher when it comes to your S&P. Bit of optimism maybe about whether deals could be reached by August 1st. Is it misplaced? That is the question. When it comes to euro dollar, we're weaker today, a contrast from yesterday because of the lack of optimism on a US-EU deal. The optimism much more potent yesterday. Your 10-year there at 4.39, a lot of pressure on the long end globally yesterday and over previous days. And we can dive into the bond market story a little more deeply next. Coming up, we're going to digest the tariff market impact next with Kallum Pickering of Peel Hunt. This is Bloomberg. It's 5:30 a.m. in New York City. Good morning. I'm Lizzie Verdon with your Bloomberg Brief, standing in for Danny Berger. Here's what you need to know. No more extensions. President Trump vows there'll be no more delays to his deadlines in his tariff agenda come August 1st. Turmoil in metals. The president announces a 50% levy on copper imports, causing a record spike in the commodity. And letter to Brussels. The European Union's new tariff rate could be declared in the next 2 days as it tries to cut a deal. Well, it's July 9th and the president wants you to pay attention. He's slapped this 50% tariff on copper imports, exceeding all expectations. And he says there'll be no deadline extensions. And he says there are more announcements in the mail. And this market is tired. Today was meant to be the day that we got certainty, but starved of it. US futures not pointing that much higher, though we have flipped into the green now. S&P E-mini futures up 0.2%. Now, let me take you to your bond market as well, because we've seen 5 straight days of selling pressure for treasuries. Long end yields climbing globally yesterday. The 10-year now at 4.39. But we've got to talk about copper, because we saw this record spike in New York futures yesterday, a drop in the global benchmark, a watershed moment for the red metal according to Citi, and trading now at 5.52 cents a pound stateside. But let's look at what stocks we should be watching this morning. Joe Easton's here with that. Hey, Joe.
Hey, Lizzie. So I'm watching automated driving software in the pre-market today, but it's not Tesla, the one we tend to look at. It is Mobileye. Now, we are getting reports of a share sale by Intel, potentially around $800 million worth of Mobileye stock, and the stock coming down, was down around 3% earlier, coming back up very slightly, but keep an eye on that one later. This kind of representing Intel needing cash to bulk up its defence against the rivals like TSMC in the chip space. Then I've also got a couple of pharma stocks on my radar. As Lizzie mentioned earlier, there's a report in the Financial Times of Merck doing a deal for Verona Pharma, a UK-based company with a listing in New York, potentially at a 20% premium worth around $10 billion. And therefore, we're seeing that stock higher. Also a little gain for Merck today. And then finally, RX Sight. This is a maker of eye lenses. A big profit warning for this one. Going to be a messy open for that stock. The company warning that doctors not recommending its technology enough in the eye care space, and therefore they are pulling their guidance today. That one is set for a rough open. Keep an eye on RX sites at the open of trading in New York, Lizzie.
All right, thanks, Joe. Great work. Now, let's take a look at the tariff impact of all of the announcements we've been hearing over the past 24 hours. Kallum Pickering, chief economist of Peel Hunt, weighing in on the impact of that trade policy. He writes, quote, "The story of the past few years for major economies is one of resilience and adaptation in light of enormous shocks. So, can the economy bounce back this time?" Kallum joins me now, I'm pleased to say. Lovely to see you.
Good morning.
Good morning. You know, we're looking at August 1st as the new deadline, but we thought we were going to get clarity today. Why on earth would anyone be optimistic that we'd get more clarity in 3 weeks' time?
Okay, so the optimism just, I think, comes from the resilience that we see in markets, and specifically the equity market. There are, of course, a lot of moving parts and lots of uncertainty. If we cut through the noise, I think the market is moving up for the following reason. Tariffs are likely to give us a bit more inflation than we thought. Not so much inflation that the market's changing its view on the Fed, which is the Fed's likely to cut probably 2 more times this year, a couple more into next year. And base case is US economy is going to continue to muddle through with OK growth. Like, the polymarket odds of a US recession have not gone up on these announcements. This is unlike in April. So OK growth, a bit more inflation, falling interest rates, that's good for equities as a general rule. You're pricing in the additional nominal revenue and you're getting a bit of a kicker on the discount rate.
There's loads to unpack there. I want to start with the inflation story because, of course, we're looking ahead to CPI next week. These new copper tariffs were far beyond what anyone expected, right? And this is important because it goes into EVs, it goes into data centres. How much does this add to inflation?
It's hard to say. It depends, of course, how much pricing power firms have with the final consumer. And the reason I start with that point is that's the key thing for the Fed. Like, the Fed's in a bit of a bind. It's two sides to its mandate. And always from the inflation perspective in markets, just think about what the Fed would do. The employment side of the mandate and the inflation side of the mandate are now on a collision course because of these tariffs. You put up tariffs, that depresses growth, it weakens employment. And you can see, actually, if you look at some of the ratios, some of the signals, like the hard to get jobs versus easy to get jobs, they're pointing to a bit more unemployment. So the Fed is probably thinking, actually, we're heading into a weaker economy, we need to cut. But now you have this uncertainty about how high inflation goes because of these tariffs. This is now a real-time inconsistency problem for the Fed because monetary policy works with the lag. I think the danger that we're facing here is the Fed's forced to wait a little bit longer to see just how much inflation comes through. That weakens the underlying economy, but then the Fed has to move with such a delay that it's too late, and then we start to see some real downside risks.
The good old monetary transmission lag.
That's exactly, yeah.
But look, what level of tariff rate, effective tariff rate, triggers a recession?
Oh, hard to say. You know, in all likelihood, we're going to be in the high teens here.
Yeah.
Right? Say 16, 17%. Of course, that's a bit of a guess because it depends what the content of the letters is. The rest of the world is not retaliating in a major way. I think this is really important. So if we consider where we were at the start of the year, this is now, from the US side, much worse than the worst case scenario. From the other side, it's less bad. So we haven't had this tit-for-tat escalation. The rest of the world has not descended into tariff wars. Yet. I don't think it will. I mean, the irony in all of this is economists actually agree on the issue of tariffs. We're notoriously disagreeable, but on the issue of tariffs, we're in agreement. Other countries seem to have listened to that concern, and they've learned the past history lessons. America is not in this sense. That said, the US economy is just not ready for a recession. You don't have piles of inventory lying around. You don't have excesses in retail spending or industrial production. They haven't built too many houses. All of these features are not present. Those are the features that usually go pop when you are hit with a shock. And so base case here should be slow growth with a recession risk. Probably about 25% recession risk. The danger for the recession comes if the Fed can't react to downside risks and the market suddenly has to change its view on how much the Fed can cut.
But Kallum, before you sat down, we were talking about how you're here visiting clients. It's a very different mood from the last time you were here. Before, there was all this confidence about tax cuts and deregulation. How does the sequencing work? Because surely that's what matters most for investors. When you get the boost from tax cuts and deregulation and when you get hit from tariffs, what's the sequencing?
So at the start of the year, you had huge optimism on this side of the Atlantic that Mr. Trump would cut taxes, he would deregulate, but then Congress would hem him in on trade policy. So far, we've had no restraint on trade policy. The market is concerned that fiscal policy will just add to debt risks in the long run. And, okay, big question mark over deregulation. So the sequencing is just a complete muddle right now, and at least it's not like the market thought. And if you look at early year expectations for US growth, 2.5, 2.6%, the market's probably down to about 1.3% now. That's a huge drop, but it's the specific type of uncertainty that we're facing. We say uncertainty in markets as if it's just something special. It's not. We're always faced with uncertainty. Who knows what tomorrow holds? We have event horizon risk, which is rolling. So every few days we say, okay, we know tomorrow, we know tomorrow, we know tomorrow. And then you have the moving target risk. What is actually the aim here? This feels a lot like Brexit. And it really does. I mean, the only difference is I had hair.
PTSD, Kallum.
Yeah, I had hair when Brexit happened. I look at the state of me now. The problem you have is, for markets, how do you take on risk when you don't know what the deadline is and what the deadline actually involves? The consequence for the UK was markets worried much too much about the near-term economic consequences, didn't factor in the long-term market impact. That's roughly what we see now in the US, where in April we had big fears of a US recession. This time the market is not more worried about a US recession despite the bad news, but now we see the long-term consequences for markets, which is, does the US on a relative basis underperform in equity markets? Does the dollar weaken on a structural basis? I think these are the themes that actually will matter much more over the next few years than any near-term economic consequences.
Look, you brought up Britain, so let's just go there. It's a question I asked Iain Stealy earlier. We've kind of had a calm down since the gilt market sell-off last week on the uncertainty around the Chancellor's position, but, you know, the fiscal headache's still there.
That's right.
What's the next catalyst for that sort of sell-off again when we know that it could infect the global bond market?
Okay, so downside risk to UK economic activity comes squarely from the risk of higher taxes. That later this year. The challenge there is those higher taxes are likely to come from either fears that global inflation will be higher than expected, which would push up US rates and then push up UK rates, or fears that global growth would be weaker and then that would drag UK growth down. So the Chancellor is in a very difficult position where she's going to be forced to pursue pro-cyclical rather than counter-cyclical fiscal policy. She's going to have to raise taxes if growth is bad, and she could cut taxes if growth is good. I don't think the market is fully factoring in where we're going to be at the end of the year from an inflation and rates perspective if we just have a base case scenario. Base case scenario is we worry a lot about inflation near term in the UK because of energy prices, in the US because of tariffs, but by the end of the year it will have washed out. We worry whether the Fed can cut, whether the Bank of England can go a little bit further. In all likelihood, we'll get at least one cut from both central banks before we get to the fiscal announcement in the UK. And so bond yields are now pricing the ex-ante inflation risk and uncertainty about rates. By the time we get to the budget, bond yields are likely to be lower because we'll be past the major part of the inflation risk. We'll see that central banks are cutting. And so I wouldn't be surprised, actually, if these bond yields, which are a worry for the Chancellor now, are actually the thing that saves her from big tax hikes towards the end of the year.
I've often thought that the market is the shield to Rachel Reeves right now. Kallum Pickering,
Thank you so much.
Good to see you. See you when you're back in London. Kallum Pickering there of Peel Hunt. Now, to the other top stories trending on the terminal this morning. Sources say that SpaceX is discussing plans to raise money and sell insider shares in a deal that would value the company at $400 billion, roughly. That would mark the largest ever valuation for a privately held US company, surpassing SpaceX's previous record of $350 billion. A representative for SpaceX didn't immediately respond to a request for comment. And Sam Altman hasn't yet spoken to Mark Zuckerberg since Meta took some of OpenAI's top engineers. But he looks forward, he says, to a meeting with Zuckerberg at the Sun Valley conference this week. Altman was speaking to reporters at Sun Valley about retaining talent.
I think we have obviously we have an incredibly talented team, and I think they really love what they're doing. Obviously, some people will go to different places. There's a lot of excitement, I guess we could say, in the industry, but no, I think we feel fine.
Fantastic eyewear. And speaking of which, sources say that Meta bought a minority stake in the world's largest eyewear maker as it deepens its commitment to smart glasses. The stake is worth $3.5 billion, and the two companies have worked together for several years to deploy AI-powered smart glasses. Representatives for both companies declined to comment. Well, coming up on the programme, President Trump sows fresh chaos in the metals markets. More on Trump's latest tariff threats next. This is Bloomberg.
I believe the tariff on copper, we're going to make it 50%. We'll be announcing something very soon on pharmaceuticals. We're going to give people about a year and a half to come in, and after that they're going to be tariffed if they have to bring the pharmaceuticals into the country, the drugs and other things into the country. They're going to be tariffed at a very, very high rate, like 200%.
President Trump's tariffs are here to stay, and he's ruling out any further extension after the initial deadline for his so-called reciprocal rates was passed overnight. Metal and pharma stock markets are also reverberating after the president touted substantially higher sectoral rates for those industries. Let's get team coverage now. Bloomberg's Tyler Kendall in Washington and Stephen Carroll in Brussels join me this morning. Tyler, let's start with you. We started the week, of course, talking about President Trump having the wind in his sails from the one big beautiful bill, and yet here we are. It's July 9th and he's only got 2 trade deals in the bag, and he's ramping up the threats on copper and sectors like pharma. What's the mood in Washington?
Yeah, hey, Lizzie. Well, you're exactly right. Congress was able to pass that reconciliation package by that self-imposed July 4th deadline. And now with those lawmakers out of town, those Republicans feel like they've done their job. But of course, we are still waiting for some more forward progress when it comes to the tariff plans. And the reconciliation package and the tariffs really do go hand in hand in the administration's view, considering that we had the Treasury Secretary Scott Bessent yesterday in the Oval Office tell reporters that they're projecting to bring in $300 billion worth of tariff revenue by the end of this year, of course, considered to be part of an offset when it comes to the $3.4 trillion in projected deficit spending because of that tax package. The administration wants to see sort of a confluence of economic factors happen here over this summer, but they need to show some forward progress on these deals. And perhaps that's why we're starting to see these letters go out this week, with President Trump threatening additional ones coming this morning. He said that we could expect a minimum of 7 letters in a first batch and then additional ones later on in the afternoon, because one thing is for sure, the administration has said this is part of their maximum pressure campaign, Lizzie, to get our trading partners to put their best offers on the table.
But on copper, Tyler, what's the president actually trying to achieve here? Because you've got analysts saying that the US just doesn't have the capacity to be self-sufficient in copper. And we just heard there from Kallum, it's going to add to inflation for the US consumer, given its use in EVs and data centres, for example. Is it really all about revenue?
Well, in this case, we have to keep in mind that copper, these sector-specific tariffs, are enacted under Section 232 on the basis of national security concerns. These are those sectors that the administration has deemed vital to U.S. interests, and they want to see a boost in domestic manufacturing. And copper would fall into this bucket, considering that net imports make up about 36% of U.S. demand, according to analysts at Morgan Stanley. And the president wants to see the U.S. boost its manufacturing on this front. But of course, without that U.S. capacity, it could also undermine that goal by perhaps steering exporters elsewhere, such as China, one of our main competitors, when it does come to these metals. Now, we knew that these tariffs were coming. The administration had launched a Section 232 investigation into copper back in March. Typically, these take 9 months to complete, but it's clear that the administration is working on a more expedited timeline here in order to get this done. We didn't know what the date or the rate would be, but I would point out 50%, while that does mirror the 50% that's currently in place on steel and aluminum. The baseline for the sector-specific tariffs had been 25%, so that is considered to be a pretty high barrier that these importers are going to have to contend with, as we saw really copper surge earlier this year to get ahead of these tariffs. But Lizzie, at this point, that window is starting to close.
Well, Stephen, Tyler just mentioned some of those letters that could be in the mail. Yesterday, we had euro-dollar up on hopes of a US-EU deal, but now Trump says he's not far sending off Brussels a letter itself. What do we know that's going on behind the scenes in the US-EU talks right now?
Well, behind the scenes and in front of cameras as well. We heard from the European Commission President Ursula von der Leyen at the European Parliament just a couple of hours ago, talking about the positive moves that were coming out of those talks, referring back to her phone call with President Trump on Sunday as well. Interesting how you read those comments about a letter, because the President, of course, we know the letter contains those unilateral tariff rates. But the President also said yesterday that it contains a deal, and a letter means a deal. So there's still some optimism that could be read into those letters today. And that's certainly the signals that we're getting both out of the US and out of the EU on this, is they are getting close. They're nearing a deal. They're not there yet. And we know from our previous reporting on this subject that there has been that sort of coalescing around the idea of accepting a 10% tariff as an interim deal to allow further negotiations down the line, and getting into the details of which sectors are going to be affected by what is where the European negotiators are really focused now, trying to secure some key concessions for industries that are really important to them.
Yeah, we report that Airbus could be one of the lucky winners out of this deal, Stephen. Who's likely to be the other winners and losers in a potential US-EU deal?
So the issues that we know that they're making progress towards getting a carve-out from that 10% tariff are aircraft parts. So Airbus, of course, big player there. Also wine and spirits we've talked about before. And then there's the thorny question of cars. What's under negotiation, although not quite at a deal yet, we're told, is this question of whether those car manufacturers who manufacture in the US, so the likes of Mercedes, BMW, Volkswagen, will actually get a sort of a quota allowance for a certain number of cars they can then export to the United States from Europe without tariffs. What the US, we're told, is working on is a model that would be a one-for-one exchange. You produce one car in the US, you get one tariff-free car coming from Europe. European negotiators aren't quite keen on that model, but that's where they're negotiating around. What that wouldn't help would be the likes of the luxury car makers, Porsche and Ferrari, because they make all of their cars in Europe. So they wouldn't be open for this sort of exchange or barter system that's under negotiation in the car sector.
Excellent coverage. Stephen Carroll out of Brussels and Tyler Kendall in DC. We thank you so much for that analysis. Now to commodities, because you've got oil prices holding pretty steady as traders weigh signs of swelling US crude stockpiles and the fallout, of course, from President Trump's tariff regime. Now, it comes after OPEC Plus ramped up output over the weekend in a battle for global market share. And joining me from Vienna, where OPEC is having a seminar, is Bloomberg's Joumanna Bercetche. Jou, so good to see you in Vienna on the ground for us. Well, this is a biannual summit. Just talk us through how much the oil landscape's changed over the past 2 years, because we don't want to get too preoccupied with the busy dynamics of the past few weeks, of course.
Yeah, well, there's a little bit of both, of course, and we can talk about both. But I will just say that this is a seminar that takes place every 2 years. It's organized by OPEC here at the Hofburg Palace. We're standing outside. Bloomberg News has requested accreditation, but we have not heard back despite multiple requests. That being said, it is an opportunity for some of the biggest industry leaders around the world to come together to talk about some of the pressing issues of the day in that space. And you mentioned perhaps the role or the participation that the energy has played in conversations over the last couple of years. And I think now we just came off the opening speech at the OPEC seminar. His Royal Highness ABS delivered it, and he was talking about the more pragmatic approach that is needed vis-a-vis the energy transition, and that it has to also be pragmatic and affordable. He talks about the huge energy poverty still that exists in many emerging market economies, and the fact that hydrocarbons, and this is of course an OPEC seminar, still fundamentally need to be part of the solution. So those are some of the long-term discussions that are taking place here around energy security, around the transition, around financing, and of course around technology. But of course, some of the short-term questions, Lizzie, are about those recent OPEC decisions to bring extra production back to the market, and whether at this point the market can sustain that extra supply.
Let her in, guys. I'll vouch for her. She's very well behaved. Joumanna Bercetche reporting from the OPEC seminar out of Vienna. We thank you. This is Bloomberg. Now, for a look at what's ahead today at 2 p.m. Eastern, we've got the latest batch of Fed minutes, plus the OPEC International Seminar is ongoing in Vienna, as we just heard from Joumanna Bercetche. And don't forget, it's day 2 of the Sun Valley Conference as well. Let's just check in on your macro movers. We've got to look at your metals space. We've talked a lot about these copper tariffs, and you've seen this record spike in New York futures, a drop in the global benchmark, a massive premium here, suggesting that you're going to get a bit of rerouting, we're in New York, of that copper and around the world. But that's it for your Bloomberg Brief. Surveillance is going to take it from here. Look, there's gold on a downer. This is Bloomberg.